Hello, I'm Marco Davis, President and CEO of the Congressional Hispanic Caucus Institute. Welcome to CHCI's 2023 Capitol Hill Briefing Series. This series is the culmination of CHCI's premier 9-month postgraduate fellowship program, which offers exceptional Latinos from throughout the country unparalleled hands-on experience working in public policy here in Washington, D.C. This unique fellowship program seeks to enhance participants' leadership abilities, strengthen their professional skills, and increase the presence of Latinos in public policy areas, this year specifically in the areas of health, technology, housing, education, and the environment. CHCI is thrilled to offer our postgraduate fellows the opportunity to share their perspectives on policy issues they're passionate about, and convene leaders in this work for an informative conversation. We'd like to thank our postgraduate fellowship program sponsors, whose support for the program is invaluable. The sponsors include Meta, the PepsiCo Foundation, America's Health Insurance Plans, the Walton Family Foundation, Bristol Myers Squibb, Microsoft, DaVita, Wells Fargo, and CVS Health. During and after today's session, you can keep this important conversation going and broaden the number of people engaged by using the hashtag CHCIFellows on social media. We hope that you will. To learn more about our postgraduate fellowship program, as well as our other leadership programs and special events, please visit chci.org. And we encourage you to reach out to our fellows directly via LinkedIn to learn more about their policy topic, and also please help them connect with job opportunities for when their program concludes in May. Thanks so much for joining us. And now, enjoy the discussion.
Hi, I'm Sherrod Brown. It's an honor to serve you in the United States Senate. David, thank you for the invitation to speak, and thanks CHCI. CHCI Graduate Fellowship brings exceptional talent to Capitol Hill. It gives fellows a platform to share their expertise, just as David is doing today, and as he's done while on staff of the Banking Housing Committee for the past several months. David works closely with my staff on homeownership and consumer protection issues. David is curious. He thoughtfully provides valuable perspective on the complex interaction of federal, state, and local housing laws. He's dedicated to the issues that matter in people's lives, issues that impact families in Ohio and across the country. His research into contract for deed arrangement will help inform our committee's work on the way these agreements can help or hurt access to affordable homeownership and help us better protect Ohio families. David, we're lucky to have you today. He'll be talking to you all about Hispanic homeownership and alternative home financing agreements. His professional experience providing legal help for low-income clients, his commitment to improving access to homeownership for families across the country make him a valuable member of our team. Thank you, and please join me in welcoming today's panel, David, to today's panel discussion. Thank you so much.
Thank you, Senator Brown, for those kind remarks and for your commitment to providing every American the opportunity to enhance their family's lives through homeownership. My name is David Ruedas, and I am the 2022-2023 CHCI-Wells Fargo Housing Graduate Fellow. I am delighted and honored to be moderating today's discussion alongside our expert panelists who will provide insight to their experience and research on alternative home financing arrangements. I would like to welcome you to the 2023 Congressional Hispanic Caucus Institute's policy briefing series. And with that, in the United States, homeownership is the bedrock of the American dream. For decades, owning a home has been a core tool for families to build generational wealth. And aside from its wealth building capacity, owning a home gives families stability and a sense of community. Americans finance their home mainly through a conventional or non-conventional mortgage. However, not all Americans have had the same access to these products. In 2022, roughly 74% of white households owned their homes, with roughly 48% of Hispanic households. This disparity can be attributed to many factors, such as creditworthiness, access to financial institutions and services, or even income. To add some context, the mortgage denial rate for Hispanics hovered around 22% in the past 2 years. Further, 3 in 10 Hispanics are either unbanked or underbanked, which also contributes to their inability to access financial services. Income also plays a role when looking for a home. In 2021, the median income for Hispanic households was roughly $58,000, and the average price home in 2022 was around $348,000. While we can dive into each of these factors and the roles that they play, unfortunately, we're short for time. And if you would like to learn more, you can do so by reading my white paper. Today, we are going to focus our attention on the alternative path to home ownership, one in which many Hispanic households have undertaken due to the barriers discussed. These barriers lead many Hispanic families to resort to risky alternative financing arrangements, and these arrangements can provide Hispanic families who would otherwise be excluded a path to home ownership. However, it comes at a cost. These arrangements are not federally regulated, they're poorly regulated across states, and they offer limited legal protections. Hispanics using alternative arrangements go on to experience higher costs, higher evictions, loss of equity, and other unforeseen consequences. Without proper regulations, access to small dollar mortgages and affordable housing, Hispanics across the country will continue to use these arrangements, further contributing to the lack of homeownership within our community. To combat this increasing concern, federal and state governments must take action to provide the housing market with affordable housing units, small dollar mortgages, and regulation of these agreements. That said, please help me to welcome today's panelist. Our first panelist, Tara Roche, leads Pew's home financing project, conducting original analysis of the safety, affordability, and availability of small mortgages and alternative financial arrangements used to purchase manufactured homes and other low-cost housing. Tara?
Hi, David. Thanks to you and CHCI for hosting this discussion today. Glad to be here.
Thank you. Our second panelist, Max Mayer, leads the economic justice work at Mississippi Center for Justice. MCJ focuses on combating predatory lending through alternative programs, foreclosure prevention, expungement, and justice court access. Max?
Hi, David. It's a pleasure to be with you today. Thank you.
Thank you, Max. And our final panelist, John Green, is the managing principal of Black Star Real Estate Partners. He has over 20 years of real estate and finance experience and has managed approximately $5 billion worth in commercial, multifamily, single family, and mixed use properties throughout the nation. John?
David, thanks so much for having me. Excited to join the discussion today.
Thank you, John. And for those who have attended the previous policy briefings, today's format will be a little bit different. I will give each panelist roughly 10 minutes to provide our audience with the necessary information to understand today's topic. And at this time, I'm going to give the floor to our first panelist, Tara.
Great. Thanks so much, David. I do have a short PowerPoint to walk through. Let's see if we can load that up. Excellent. Great. Okay. We can go ahead and skip to the next slide. Perfect. So as David mentioned, I'm a project director for Pew's Housing Policy Initiative. And over the past several years, our team's been examining the challenges with originating small mortgages and the other arrangements that people sometimes use instead of a small mortgage to pay for their low-cost homes, both site-built and manufactured homes. Even though we're in a rising home price market, low-cost homes are still widely available. But finding small mortgages is difficult because they're costly for lenders to originate. And when small mortgages aren't available, it may lead some home buyers to choose alternative financing instead. So what is alternative financing? In short, it's kind of an umbrella term to describe a number of arrangements that aren't typically subject to traditional mortgage rules. So this includes land contracts or contracts for deed, as they're sometimes known, lease purchases or rent-to-own agreements, seller-financed mortgages, or personal property or chattel loans, which are specifically for manufactured homes. Each arrangement has different features, but the key distinction is when and how the buyer receives legal home ownership. For example, in a land contract, the deed to the home typically doesn't transfer until the final payment is made, So the buyer doesn't usually have full legal home ownership up front, unlike in a mortgage arrangement where they do. In lease purchase agreements, there's typically a clear lessee or tenant period, and then that option can be exercised by the buyer where they want to convert to home ownership. So they might take out a mortgage to fulfill the rest of that agreement. Seller finance mortgages, typically the deed is granted to the buyer up front, so they do receive that full legal home ownership and then continue to pay the seller to fulfill the contract. And lastly, personal property loans. These are most similar to mortgages, and they can be a good option for manufactured home buyers who cannot access a mortgage, although they do come with higher interest rates and slightly fewer protections than mortgages. So now that we've talked a bit about what alternative financing is, let's talk about some of our survey research on this market and borrowers' experiences. We found that 36 million Americans have used alternative financing to purchase a home, and this is far bigger than we thought this market would be. It really shocked us, the size of it. Today, roughly 7 million homebuyers are currently in an alternative arrangement. And so in total, it's about 1 in 5 people who have ever borrowed to pay for their home, whether it was a mortgage, a land contract, or another arrangement. About 1 in 5 of those have used some kind of alternative financing. And we wanted to dig in more deeply here because government agencies, legal aid attorneys, academics, and others for years have been flagging concerns about the harms associated with these arrangements, but until now had little information about the scale of the market nationally. So the survey also found disparities in alternative financing broadly across race and ethnicity. In particular, while 21% of home borrowers overall have used alternative financing, about 34% of Hispanic home borrowers and 23% of Black home borrowers have used alternative financing, compared with 19% of white home borrowers. And these reflect broader disparities in the housing market, as many of you know, and raise additional concerns, especially given that Hispanic and Black families were among the hardest hit by financial troubles during the pandemic. And also borrowers in these arrangements typically receive less federal and state support. We just put out a new analysis on this, which I'd be happy to share after, that looks at the pandemic supports available to households using alternative arrangements compared to those with mortgages or paying rent. The survey also found that 23% of home borrowers earning under $50,000 annually were in alternative financing arrangements, compared to 3% of borrowers earning more than $50,000. But this isn't just a story about income. This highlights in part how difficult it is to get small mortgages for low-cost homes, since the lower to moderate income home buyers would be most likely to seek low-cost homes that lenders have trouble issuing small mortgages to finance. So I want to just briefly cover how the laws for these arrangements work. In short, it's a relatively weak patchwork of federal and state laws that govern them. Most states don't have specific laws, but when they do, they vary widely. So consumer protections and the interest rates vary a lot across and even within states sometimes. Where states do have laws, they're typically for land contracts. But even then, fewer than half of states have land contract laws. And also for lease purchases, which are kind of unique here as well, for the beginning part of that arrangement, where there's a landlord and a tenant agreement, that should typically fall under the existing rules that govern renter, landlord, tenant laws in that state or that jurisdiction. But we've seen examples of where sellers are not abiding by those laws and calling the arrangement something else. So we spent a lot of time examining the literature that looks at the risks associated with these arrangements. And so I'll just briefly summarize them here. Again, because the laws vary so widely, a lot of the risks are borne by borrowers. So because, at the top I mentioned, there's the inability to sometimes get full legal home ownership up front, especially for land contracts and lease purchase agreements. Borrowers are unable to build equity in the home. They're unable to borrow against the home. That unclear ownership can lead to quick evictions and foreclosures. There's unclear responsibilities for who's responsible for the upkeep and the maintenance, the taxes, and so on. There are risks to sellers, although they're more limited and they're not as acute as they are for buyers. For example, non-payment from the borrower or the buyer. Sellers are still on the hook, especially if they have another financing agreement that they're responsible for paying on the home. And there's also the possibility that the home value can decline if the home goes into judicial sale due to some kind of disagreement with the buyer. And lastly, there are risks to state and local governments. Again, the unclear responsibilities can make it difficult for local governments to help target resources for homes. Again, we saw this during the pandemic, where alternative financing home borrowers were far less likely to apply for and receive aid, unlike those with mortgages. So in the last couple minutes here, I just want to talk about manufactured housing briefly, which has its own set of unique opportunities and challenges, because these can be an affordable option for home buyers who are looking for low-cost homes. They can help alleviate some of our nationwide problems with the shortage of housing that we're having right now. Go to the next slide. However, they have some unique challenges because, unlike in mortgage transactions on site-built homes, manufactured homes are typically sold as personal property and not real property. So instead, many home buyers may borrow a personal property loan or even another kind of arrangement. And the personal property loan includes just the home itself and not the land underneath. So that would have to either be owned already or financed separately in some way. As I mentioned at the top, personal property loans can be good options for folks who cannot access mortgages, although they come, again, with higher interest rates and slightly fewer protections than mortgages. In 2019, among manufactured home borrowers who also own the land underneath their home, so in theory they could qualify for a mortgage, 24% of Hispanic households had personal property loans instead of mortgages, compared with 15% of white and 13% of Asian households. So we do see an overrepresentation here of personal property loans for Hispanic households. And just to put a final point on it, the way the home is titled in manufactured housing matters a lot because of this impact on financing. And more broadly, most loan applications for manufactured homes are denied. So it's already very difficult accessing safe and affordable credit in the manufactured housing market. This is something we're going to spend the next couple of years exploring more deeply in our work, because the financing and land ownership challenges really undermine opportunities that manufactured housing can offer. So I'll stop there, and thank you again, and looking forward to the other presentations and some Q&A later.
Thank you for that information, Zara. And next we have Max. So Max is a lawyer for MCJ in the state of Mississippi, my home state. And so I'll give you the floor, Max.
Great. Thank you again, David. I'm particularly excited to talk with you all today about kind of the intersection of my work history in a lot of ways. I originally came to the Mississippi Center for Justice working on the immigration law team. And a lot of that was based on the legal response to the 2019 ICE raids at poultry factories here in central Mississippi. And then I transitioned into the economic justice role that I'm in now as the director of the team. And a lot of my work now is based on foreclosure prevention and some predatory practices that a lot of home sellers as well as mortgage companies take on here in the state. And so I had I wouldn't call it a benefit necessarily, but the experience of interacting with a lot of my former immigration clients in the context as home buyers and, folks that are, coming into the economic justice world. And so, I'll say at the outset, a lot of my experiences with clients that I've seen so far with some of these alternative paths to home ownership have oftentimes been negative. I was joking earlier today when I was talking with the panel before we got on about how I was really racking my brain to come up with, a success story, which I do have, and I'm sure I'll have a chance to share that later. But most of what I'm going to talk about here is going to be experiences on the ground here in Mississippi that had pretty negative outcomes for Latinos and for particularly immigrant families here in the state. So I'll say that we in Mississippi do not have the protections for folks that are in some of the non-traditional home ownership pathways. In particular, I'm going to be talking about lease to own agreements or rent to own agreements. And so I'll just kind of jump in to talk about what those look like here. So oftentimes what we'll see is that folks are, and really and I think, David, you touched on this at the beginning, home ownership is supposed to be the cornerstone of folks being able to have the, so-called American dream, being able to build wealth, to be able to keep within your family and pass it on to your children. But what we've seen historically is, that pathway to home ownership has been restricted, oftentimes on the basis of race and also gender, and as we've seen in recent years, immigration status. And when you tell someone, hey, I have this fantastic opportunity for you, and not only is it going to be great for you, but for your family, people are going to, tune in and want to take advantage of that. But so often there is a hook and a catch that ends up, the floor comes out from under folks, and that is a lease to own agreement. So the way that these have worked and what I've seen is a homeowner will, approach someone. Oftentimes it's someone who's actually already been renting their house, maybe for years. They have a relationship previously, and they'll say, have I got a deal for you? If you don't need to worry about a down payment. You don't have to worry about financing. You've been a fantastic renter for the last 5 years. You've made on-time payments. We'll go ahead and sign this, agreement, and it'll be an actual, recorded, written contract, not recorded in the sense with the deed or anything, but just, it's something that's written down, specifying that, if you make X number of on-time monthly payments for 10 years, totaling $40,000, then you will have, you will be able to gain title to this home. But oftentimes the devil's in the details. And what we've seen, and I'll talk specifically about one instance in a moment, but what we've seen is clauses in the contract that are constructed in such a way to basically set people up for failure. Most recently, we had, and COVID, I will say, exacerbated a lot of this. And we saw, because of non-payment, folks, because of hardship, folks ran up against these clauses in such a rapid manner that, typically you don't see that kind of numbers of people who lose their homes that quickly. And then, as I'll probably mention later on, a lot of the COVID protections with, the forbearance and other, fantastic opportunities that were, and remedies that were really intended to keep people in their homes are not available to folks that are in non-traditional homeownership pathways. So in a rent-to-own agreement, for example, you were not given the automatic forbearance period from foreclosure that you might have if you have a mortgage through your local credit union or through, I'm looking at your screen, David, says Wells Fargo Housing. Wells Fargo has a lot of mortgages as well. And those are protected not only by RESPA rules, which I'll talk about in a second, but also protected and fall under the umbrella of the response to the pandemic. And so what we saw during the pandemic was one person in particular who had a rent-to-own agreement. They had actually, it was for $45,000 for the purchase of a home. And they had made payments, I think it was up to $43,000 on time every month. And then the pandemic hit, and they had 6 months left of $500 payments, and they weren't able to make that first month's payment in March of 2020. And the homeowner, the person who's actually selling the house, basically just took them to court, but waited. They waited actually about a year or two. And in the process of that year or two, I will say my client, and this is an ongoing matter, so I won't share a lot of identifying details. My client actually did pay off the remaining 6 payments. So they paid the total of $45,000. The homeowner actually waited until after all the payments had been made to then bring an eviction action against them in justice court. In Mississippi, justice court is a small claims court with matters limited to $3,500. Judges don't have to be attorneys or even college graduates. They're elected officials. Certainly not the kind of a venue or the jurisdiction that they should have over a $45,000 home, which typically should be in chancery court. But because, according to this homeowner, in the rent-to-own agreement, it said that one missed payment would automatically transition this rent-to-own agreement into a regular rental agreement. And so essentially what this homeowner was saying, or, the homeowner that was, trying to sell this house, allegedly sell the house, I did air quotes in case you couldn't see, they automatically tried to classify this as just a regular rental, run-of-the-mill rental agreement, one that does not have any of the sort of protections of folks, that would have to go through foreclosure, and then, have, it's 120 days, which again, those things are set by RESPA, which I wrote down, and I use the acronym so much I don't know. It's the Real Estate Settlement Procedures Act. But basically, RESPA sets pretty hard line requirements to protect home buyers in a lot of these, mortgage contexts. Things like having an escrow account or providing for mandatory notices, before starting a foreclosure process, and then even after a home has been foreclosed on, forcing the foreclosing, mortgage company to go through a required eviction process to actually get the person out of the house. None of that exists in this context. And so we're fighting this case. We're working to try to get it transferred into county court instead of justice court. But, this is not the exception to the rule. This, in my experience, especially here in Mississippi, has been the rule. I will also mention that, not all traditional financing options that we see are safe options especially for Latinos and especially for immigrant Latinos in Mississippi. We've seen folks that are targeted for things like balloon mortgages. So, people who are, and this was actually a classic example of a client of mine from the immigration context. She was detained for almost a year, got out, was able to get lawful immigration status, had a social security number. First thing she wanted to do, as I talked about before, is start seeking out the American dream and buy that house. And when she went to the bank to finally, purchase this home, she was presented with a balloon mortgage payment. So, I mean, again, these are folks that are not coming with counsel. They're not experienced home buyers or sophisticated purchasers, and they're being steered towards riskier mortgages that are more likely to lead to foreclosure. And so, again, what we've seen here is in Mississippi is a situation where people are being exploited, oftentimes by the well-to-do against the folks who don't have any. And the end result at the end of all this is people end up, not having the home they thought they had. And not only do they have that, but they might end up with debt or negative reports on their credit score, which can carry with them the sort of long-term repercussions that that shut the door out forever or for decades from them having an opportunity to own a home down the line. I think, one thing I'll just mention quickly is that, when you purchase a home, the protections that you have as a home buyer are things like, and I made a little list, things like, you get an inspection and an appraisal. You also have to go through basic things like origination and qualification for loans. Those are all components of the rent-to-own process that don't exist. And so you can, you basically have folks just signing their name on a piece of paper that gives them no rights and sets them up for failure. I'm excited to talk more about this down the road, but I'll pause now to make sure I stay within my allotted time.
Awesome. Thank you so much for that, Max. Thank you so much, and for the work that you're doing with MCJ. And our final panelist, will be John, and John will talk a little bit about his company and the work that they do. And so, John, the floor is yours.
Okay, much appreciated, David. Again, thank you so much for the opportunity to chat with you this afternoon. These are issues that are near and dear to our heart. I am managing principal of Black Star Stability. We are a real estate investment management company that is focused on expanding the equitable ownership of affordable single-family homes. And we do that in some ways that are unique, in particular by focusing on forms of seller financing that we consider at best problematic, but much more commonly outright predatory. In particular, we tend to focus on the contracts for deed and the lease option agreements, the sorts of lease option agreements that most closely mimic them. Max gave a lot of details around why those sorts of agreements can be really problematic. And for us, ones that are the sort that asymmetrically shift the landlord's burdens onto tenants in ways that we judge as inappropriate, ones that are just tenuous, financially precarious arrangements are the ones that we try to focus on. And what we do at a very high level is to acquire large pools of single family properties that are encumbered by these sorts of contracts, and we buy them at pretty steep discounts for reasons that I'm happy to focus on a bit later. We then work with the families that occupy those homes to extinguish those existing contracts and replace them with traditional purchase and sale agreements that make them outright owners, financed by mortgages that we take back using a closed-end private equity fund that we have raised, subject to all traditional mortgage underwriting standards, ability to repay standards, licensing requirements, et cetera. But in that process, we dramatically alter the terms, improve the terms of the mortgages that they have versus the financing that they had previously, and confer a series of benefits that I'll enumerate shortly. We then take those mortgages, and I should say that these, to be clear, are by and large performing pools of these sorts of contracts. We take these mortgages that we've created, hold and season them to demonstrate payment performance, and then sell them in the secondary market and recycle the capital. What we're able to accomplish in that process, though, is pretty significant for the families that are involved. We are transferring equity outright to the families simply by virtue of completing the purchase transaction. One of the implications of the nature of these contracts, where ownership doesn't transfer until the very last payment is made, is that any equity that accrues in the property remains the seller's and actually creates a motive for them to seek to accomplish exactly what Max mentioned, to seek to strip that equity when it's available, to remove the opportunity to purchase. So we transfer equity directly to the families. There's no notion of shared appreciation, shared equity, B notes, or anything of the sort. We have a portfolio at this point of roughly 200 properties. And for the families that we've worked with, on average, we have transferred roughly $40,000 of equity per family, and that represents roughly 80% of the families that we've worked with. For those families, that is a more than 28x increase versus their net assets, so definitely a financially significant transaction for them. Monthly P&I payments come down. They have come down on average by roughly 30%, simply by the reduction of interest versus the previous terms that they had. And to the extent that a property is underwater, we absorb the negative equity that's there. So the mortgages are set at the lesser of the unpaid principal balance or the actual property value, to ensure that families aren't walking into this transaction in a way that they're set up for failure. And another significant thing that we found is, so we extinguish any existing penalties or arrearages out of hand for this. So, and that has affected roughly a third of the families that we've worked with. But what's notable about that is that we found that where there are penalties and arrearages that are present, that they are present, it's a significant burden. It tends to be roughly 3x the family's net assets on average. So once you get behind, if you think about the revenue model of payday lender, it closely parallels the sort of behaviors of sellers and originators of this sort of product we found, where the penalties are an intentional aspect of the revenue model. It becomes a significant barrier to ever amortizing. So if you find yourself getting behind even once, you often find yourself on this sort of death spiral where you can never catch up and become an outright owner. Indeed, over the research that we've done, it seems that less than 1 in 5 of the families who ever enter into this sort of arrangement ever becomes an outright owner of the property. So to the point that's been made, it's a bit of a house of cards where there's not a sincere intention to make these families owners. And so for the families that we work with, this has been a pretty transformational opportunity, and one that we are focused on scaling in ways that we think are market driven. We have a closed-end private equity fund that we've closed. We are closing. We will have a final close during the second quarter of this year. So we're in the final stages of that. So at $100 million, we think that relative to the scale of this problem, which is tremendous. We think there's more than $200 billion of contracts for deed alone, aside from the other sorts of products that are out there. We think that our $100 million is a drop in the bucket, but we think that by demonstrating a scalable, market-driven solution, we can invite more attention, more capital, and more activity around this issue. Why we focus on this particular subset of the market is because we see it as highly problematic, and we don't see a lot of action around it. As mentioned, there's not a lot of attention at the federal level from a policy perspective, and it is mostly subject to a patchwork of state level regs. We tend to observe four primary categories of problems that concern us. First is this illusion of ownership that's often sold. So Tara mentioned the uncertainty of ownership, but to put a finer point on that, many of the families that enter into these arrangements don't realize that they don't actually own the property up front. And so they think and behave as rational owners would. They put sweat equity and real capital into the properties in order to improve them. And they only realize once it's too late, once there's some trouble that's involved, that they don't actually own these properties. The second is that they tend to happen at above market prices. So the interest rates on these tend to be, again, somewhere between problematic and usurious. We tend to observe average rates that were 400 to 500 basis points wide of where prevailing mortgage rates were at the time of origination. But we've seen rates as high as 18 and 20%. That were originated when prevailing mortgage rates were closer to 4%, right? So, the range on these can be significant, and the actual contract prices themselves tend to be struck in excess of the value of the property at the time that the transaction was struck. Third is that the obligations tend to run without the benefits. So these families are taking on maintenance, insurance, and tax liabilities on transactions where they don't have the right to sell the property until the last payment is made. Any equity is not theirs. They don't have the right to lease the property. And it is a mixed bag as to whether they can do things as fundamental as deduct interest from their taxes the way that you would with a traditional mortgage. And lastly, as mentioned, there just tend to be very few consumer protections. And so this is an issue that disproportionately affects Black and Brown families. And it is geographically overweighted in places where there tend to be weaker consumer laws at the state level and high concentrations of lower cost properties. A stat to remember that we think is important is that less than 30% of all properties that are $70,000 or less nationwide are financed with a traditional mortgage. And that has a lot less to do with the creditworthiness or financial wherewithal of the families that would seek those, and much more to do with the economics of mortgage originations and lending. That the fixed costs of originating a $500,000 mortgage are substantially the same as a $50,000 mortgage. And so the industry doesn't provide enough of those. And in the absence of those small balance mortgages, products like these thrive. And so it is an arrangement that we think is condemned to fail for most families that are involved. And what is unsaid in many of the lease option conversations, the lease to own conversations, is that even if you perform on many of these agreements, the nature of the balloon contemplates that if you exercise your option, you have to ultimately rely on a third-party mortgage. So you make every payment on time. You are prepared to, you've saved and you're prepared to move forward to actually trigger a purchase, and you go out to seek a mortgage it's simply not available because the market hasn't provided that. And so excited to talk more with you and the panel about it, and I'll stop there.
All right, thank you for that information, John. And at this moment, I'm going to follow up on some of the information presented with our Q&A session. And the first question I have is for Max. Max, you had mentioned, one example of just a good outcome, right? Out of all the clients that you have, can you talk a little bit more, or in your practice, can you talk about that example and whether or not it is just due to the fact that the state of Mississippi doesn't have state regulation over these kind of agreements that ultimately lead many of them to fail?
Definitely, yeah. So I'll say the success story that I remembered and came up with was there was again, this was a client of mine that I had worked on their immigration case, and they did not have a social security number, and unfortunately, in Mississippi, oftentimes say we live in addition to being in a justice desert in a lot of ways, we're also in an information desert, and I think whether purposefully or just by the matter of fact. A lot of banks, especially in the smaller towns, don't realize that folks can open up bank accounts with ITINs, individual taxpayer identification numbers, and they don't need social security numbers. And so this particular client had been denied. I mean, I can't tell you how many times. I mean, they had been in the country for over 15 years, and they still were not able to open up a bank account with their local bank. And that was preventing them from being able to, get access to a mortgage. Their longtime landlord eventually ended up offering them one of these rent-to-own contracts over the course of 5 years, to pay it off, and they are currently in year, I think it's like 4.5 or something, 4 and 3 months. Great experience so far. I spoke with the landlord myself, and it seemed, it's not quite a seller financed mortgage by any means, but it is a traditional rent-to-own contract. But I have no doubt that this person is going to be able to perfect homeownership at the end of this trial. So I do view that as a success. Now, advocating for folks to being able to open up bank accounts with ITINs is a separate issue that we could probably spend a whole other panel talking about. And then just quickly to touch on the other issue that you mentioned, I think Mississippi does not have protections for the little guy in a lot of ways. Whether that's in the rental context, whether that's in the payday loan context. We have John. You mentioned that it's a similar model that folks crank out payday lending and these rent-to-own schemes. We have payday lending with 521% APR in Mississippi because there is absolutely no ceiling on what folks are able to actually charge folks. And so in the context of these rent-to-own agreements, I think a lot of that is just the historic systems of injustice that the state of Mississippi has created and really refined and perfected over the last 350 years, 400 years, or whatever, where so much of the wealth is concentrated in the minority of people in the state who have so much power that bills are dead on arrival when they get to the state legislature when it comes to anything that possibly touches the wealth or the power of the few to the benefit of the many who need opportunities to actually build the wealth for their family.
Thank you for that, Max. And my next question is for Tara. So in the context of these agreements, what would success look like?
Yeah, thanks, David. So to bottom line it, mortgages are the gold standard for home financing, but many home buyers use and will continue to use alternative financing. And so for them, at a minimum, success means that arrangements intent matches the outcome. Everyone goes into these arrangements with the goal of owning their home with a safe, transparent process that leads to full home ownership and all of the benefits that come with that. But that becomes complicated depending on the details of the arrangement, the expectations versus the reality of their experiences, even the federal, state, or local law that's governing that arrangement. But by and large, it's important that these contracts are structured with clarity so that the buyer and the seller understand what, the arrangement that they're going into, that there's a clear pathway to ownership, clear payment schedule. A lot of times you've seen contracts don't have all of those provisions. Things that are very clear about the shape of the home when they're moving into it so that borrowers or buyers aren't surprised with any fees or structural issues. A lot of the things that naturally come with mortgage lending, or at least where buyers or borrowers can exercise the option to forgo, say, an appraisal or an inspection, they're still given like a very clear process for doing that. For these arrangements, it just varies so widely. And so the lack of uniformity there, that's something to focus on when we start thinking about policies to improve these. But there's a lot to do in shoring up protections here. So that's one part of it, right? It's better protecting these arrangements because they will continue to exist, and looking at things that do work well for people as well as things that don't. And I'd say the second part of this, again, is because mortgages are the gold standard here, it's improving that pipeline from alternative financing into mortgages. So there are opportunities to do that, and we've talked about some of that today. And so policies should really better support that pathway. So people who do use these, whether or not they're struggling, if they want to move into something like a mortgage that's better protected and has lower costs, they're able to do that. And it's really clear what the process is for it.
Thank you for that. And John, Max had he spoke about Mississippi, right, and the lack of regulations and how that contributes to the outcomes that consumers face there. Your company operates in many states, correct? And in states where perhaps they do have legal protections to some degree at the state level. However, your company takes a different approach, as instead of promoting or supporting individuals in these agreements, your company tries to get them out of them and into a more secure kind of product like a mortgage. Is the business model simply because that these agreements, no matter in what state, no matter what kind of level of protections, are simply just inherently predatory and fail consumers?
Yeah, I would say, Tara mentioned it well, that the gold standard is a mortgage where it's possible. It's not always possible for families, but where it can exist, our general posture is that it should, and we try to work hard toward that end. I would say that the agreements, the nature of the contract itself is not inherently predatory, but the way that it is so loosely regulated makes it open for abuse, and much more commonly than not, the way that it's wielded is in ways that yield outcomes that are problematic and predatory. So a big part of the reason why we focus in the ways that we do are to advance the sort of clarity on ways that it can be accomplished. It, in this case, being to provide small balance mortgages in ways that are not extractive, that are not problematic or predatory, that provide a good faith agreement with families and provide them the opportunity to own, but also demonstrate that you can do that in ways that are scalable. The investors that we have are folks that are focused on our capacity to do good and to do well. They are a combination of mission-oriented family offices and foundations who are all, keenly focused on our capacity to execute in those ways. We tend to think that the risk in this segment of the market tends to be misunderstood, and as a function of that, tends to be mispriced. And so there are a lot of misperceptions that miss out on what we think are some common sense opportunities to provide financing in ways that are at lower cost. For instance, if you think about what happens when you simply don't have a credit score, and what the implications are for that, and how that consigns folks to alternative financing agreements, it's acute in these communities that we're talking about. Nearly 17% of all Latino families are considered credit invisible. Roughly 20% of all Black families in the U.S. are considered credit invisible, meaning they have no credit score whatsoever. Right? Doesn't necessarily mean that it's bad. Just it means that that the FICO doesn't exist for them. Impossible to get a mortgage under those cases. But if you have been under a contract like the ones that we've talking about for 10 years and never missed a payment, that doesn't factor into your ability to establish or to improve a credit score. So when we're buying these pools, we look at things like the payment performance of these families over higher payments than we are seeking to provide under the mortgages that we're providing as a credit proxy to help to justify. And what we find at this end of the market is that families tend to outperform the predictions of FICO scores for various reasons. So the reason why we do it is because we're convinced that there are ways to do this profitably and responsibly that benefit families and don't prey upon them.
Thank you for that, John. And
Sure.
for the panelists, any comments that are made, if you have any comment to that or anything that you would like to add, please feel free to do that. And in the context of these agreements and influencing outcomes, right? John, like what can lawmakers do in order to support better outcomes for borrowers using these alternatives? And I guess specifically in the sense of consumer protections and also enforcement of that.
Yeah, I think I think there's several things. Again, many of them I would say are common sense, and I would say table stakes in some ways. Part of what makes it challenging to even confront this issue is that you can't figure out where they are. It's hard to find where these contracts are because, in contrast to any other sort of personal real property transaction, it's not required universally for these contracts to even be recorded. That's a state level issue. And so if you don't know where they exist, you can't find them. You can't hold folks to task for the ways in which the transaction was conducted and for any sorts of outcomes afterwards. So there tends to be a huge, very fragmented shadow market of actors who are intentionally flying below the radar in ways that allow them to abuse folks who are least empowered to advocate for themselves. So things as fundamental as requiring that these transactions be recorded is an important outcome. Tara touched on the fact that, and I think Max as well, the fact that the interest rates tend to not be capped. That is, that could be indexed to prevailing rates in ways that provide some measure of protection for families and is something certainly worthy of consideration. I think having key language that is standard language that's required in contracts can eliminate a lot of the confusion, right? No family should enter into the purchase of a property and not understand that when they own the property and how that's structured. You should not be confused that you don't own the property and behave as an owner. So having existing standards apply, things like truth in lending standards, inspection requirements, these sorts of protections are ones that just make sense. I think there are a number of ways that you can kind of extend beyond that to help to refine the process to make it less inherently predatory, and lots of ways to help to bolster a lot of the activity of good faith actors. But those are some of the high level big first steps that I think could be taken.
And just a little follow up I want to add. So enforcement in this context could be done from a federal agency standpoint, right, such as the CFPB or the likes. Max, in a state level, a private right of action would be important in this context, right?
Yeah, I think one, and this, you got me thinking about this when you talked about policy solutions. I think there are, on a state level, there are a couple things that Mississippi could do. One would be to actually have rent to own agreements being listed at in the state statute book, so that it's not so that at the moment when they come in front of a judge, they're not just automatically classified as some crazy form of rental agreement that doesn't really give any of the sort of protections to folks that you would otherwise have, again, if you were going through foreclosure. I also think that on the state level, capping, just like John said, capping the interest rates. In the payday lending context, we've really been pushing for a 36% cap, which is still pretty astronomically high. But in the, John mentioned the example of 18%, when the for a mortgage, when the prevailing rate in the market's like 4 or 5%. We see that here. And again, folks, and I just want to emphasize this again, in a state where people are so frequently, and I mean, when I say people, I'm saying Latinos, and especially immigrant Latinos in Mississippi have been shut out in so many ways from mainstream economics or the mainstream marketplace, they, people are going to jump at opportunities that they can have in order to actually get access to homeownership. And so they will look at and say, oh, 18%, that's, I'll work extra hard to make this happen because that is how important homeownership is to folks. And that's just wrong. People shouldn't have to jump through hoops or pay extra, like a tax essentially just for not having, an authorized status or familiarity with the system. But then again, I think, you talked about private right to action. I think that could be something crafted along the lines of, if people are caught, if people are brought to court with in the tax sense, I think there's just some out and out fraud that's happening where homeowners who have the duty to be paying taxes, because, in these rent to own agreements, almost all of them actually put the onus on the homeownership or the landlord to pay the property taxes for that, for that property while the person is renting to own. But we've had instances where, the landlord or the homeowner just out and out doesn't pay the property tax for those 5 years, and then there's a tax sale unbeknownst to the renter, and by the time that renter is actually paid off the full 5 years or the full 10 years of that agreement, lo and behold, there is no property for them to actually take ownership of because it was sold in a tax sale because the person who was supposed to be paying that didn't actually cover it. So I think, getting into some of those small details that would, on the state level, that would, clearly delineate who has what duty, and if you, fall short of your duty, making that an action, a right of private action, to, type of suit that you can actually bring in Chancery Court as opposed to Justice Court. I think that would go a long way.
Awesome. Thank you for that. And for the audience, if any of the audience members have any questions, please feel free to use the Q&A and to submit your questions. And one final note, as a question, I guess, in the context of trying to foster a different kind of environment within the market. Tara and John, you mentioned this briefly about the importance that small balance mortgages can play in this market, and ultimately allowing individuals who don't have that access and have to resort to these agreements, typically, are burdened by these kind of like policies that we have. Maybe not policies, but maybe there's no incentives for banks to offer these kind of products. And can you talk a little bit more about that, Tara or John?
Sure, I can add a comment here. So yeah, we are studying some of the challenges with originating small mortgages, and the evidence is pretty clear that, especially for under $150,000, under $100,000, it's just really hard to do because of the fixed costs associated with originating mortgages. Those costs can eat up a lot of the revenue for small mortgages, which makes them untenable. So it's much easier for lenders to originate larger balance mortgages. So then the question becomes, are there ways to reduce costs to increase small mortgage lending while maintaining those good consumer and lender protections? And there are. Federal regulators are already doing some things to help alleviate those costs and have been over the past couple of years. And we're also working on some research over the next few months to really identify at quite a granular level what all of the costs are that go into originating loans, so that we can better understand where there may be opportunities to reduce costs for small mortgages and get more people into those arrangements, especially in historically underserved communities, whether that's by geography or race or ethnicity. So definitely seeing some movement there, but more opportunities to really dig in on the challenges with originating and accessing small mortgages.
Yeah, no, I would agree with those, and I would say, a lot of the sort of attendant issues around it will be increasingly important as well. We find challenges on things like property insurance, for instance. It's the mispricing of risk is one that cascades. It's not simply associated with the mortgages. We find in cases where we may be able to save families hundreds of dollars, for instance, with by migrating to a mortgage. In some cases, that gets eaten up, or a significant portion of it, from migrating from the sort of forced place, poor interest, poor insurance policies that they have, to ones that are proper insurance that protects more than just the lender's interest. Part of the realization for us that was an important one is that an agreement doesn't have to be unaffordable to still be predatory, right? In many cases, families are entering into these arrangements, and it's not that they may be stretching themselves, but it's not necessarily ones that they can afford. But that doesn't, in and of itself, mean that it's not predatory. If you're paying more than a house is worth, you're paying interest rate that dramatically outstrips the market. If you're paying on terms that are highly problematic, it can still be a very predatory arrangement. What Max described, the sort of lack of clarity into the title, where you can have a property that's encumbered by other forms of debt and be completely oblivious. The requirements under most of these contracts are that the seller doesn't have to provide clean title until the last payment's made. So they have no duty of faith, even to the family or standard of care to provide that. And small balance mortgages really help to level the playing field in that capacity. A big part of the sort of ammunition that we have in this environment is being able to buy it at steeper discounts. That really is a function of the sort of legal and regulatory environment that has really created a sort of chilling effect on the pricing of homes that are encumbered by this sort of financing. But we think that, acting in these ways to provide smaller balance mortgages, it's just going to be the primary solution. This is a problem that's existed. Look, the nature of these contracts and the actual existence of these contracts has existed for more than 100 years in this country, right? And it has primarily been associated with families that have been excluded from the traditional mortgage markets. For a long period, that was as a function of redlining and explicit policy, and now as a function of the sort of practical implications of compliance. And so, using some of the policy levers, things like the incentives of CRA and other sorts of things, can help to steer and to create incentives for banks and others to be more aggressive about finding ways to do it. And again, we're not talking about folks that are necessarily lacking the credit worthiness or the financial wherewithal in all cases to finance these. It is, if you or I go out and try to get a $50,000 loan, you're going to find it's a very hard thing to get, not because, you're not able to maintain the payments. It's just, there's not a significant supply of those. And so finding ways to bridge those gaps are important.
Thank you for that. And we do have an audience queue, and it is directed to just the panel. There are over 16 million vacant homes in the U.S. Can you talk about how access to housing is not a matter of housing supply, but rather economic resources?
Yeah, so I can start. I would say, so we echo the sentiment, and I think the economic resources in this case, in many cases, go back to the availability of financing. So one of the fascinating things that occurred with us is that I mentioned that we're providing significant equity in the transactions that we close to the families. But what we found is that that's not enough in many cases, because for the same reasons that families couldn't get a primary mortgage on their place, they can't tap the equity in that place to improve it, to address the deferred maintenance in many cases that exists with a HELOC or a home equity loan for the same reasons. And so we've been piloting a program to try to figure out to what extent we can do it. What I'll say is it's to do that period is difficult. To do that in a geographically dispersed manner, doubly so. But it really underscores the challenge in addressing the vacant home issue, which is that there has to be both incentive and capacity to be able to do that. And I think a lot of these alternative financing arrangements really sap the motivation on from both the sellers and the buyers of these until there's actual ownership to actually invest in the property, right? If you don't own the property, but you occupy it and possess it, there are severe limitations to how much you're going to invest in improving it. The property suffers, The communities suffer as a function of that, and the places hurtle toward functional obsolescence much faster. The sellers in most cases have entered into these arrangements expressly to avoid any sort of obligations to improve these. And then, as I mentioned, when there's the desire and some economic capacity to actually improve the property, the financing tends not to be available. You can't go and find a 203K loan to put $20,000 into your $50,000 property to put a new roof on it. And so creating the capacity, the financing capacity around that has to go a long way toward it. So, we are, as I mentioned, in the early phases of trying to do that in our fund, but that is that I think is the key challenge. But I will say, if you compare the costs of doing that versus the cost of the subsidies that are required to provide low-income housing writ large, in particular rental housing, in many cases it stacks up very favorably. So it's a problem that is very worthy of our attention.
Does anyone have anything to add before I move on? Nope. Okay. All right. We have another question here, again, directed to the panel. All these challenges and scenarios seem complex, even for those of us that have been homeowners. How can we help the Latinx community navigate all these options in a feasible and simple manner?
I'd be happy to talk about this one. Actually, that's all right. I think some of this is, if you split into two parts, one is going to be information facing and experience, and how folks are, traveling through the economic processes like homeownership and home purchase and learning all of this as individuals themselves. And the other side is going to be the sorts of information and structures and protections that exist for financial institutions like credit unions and banks. I think on the side of, in the individuals themselves, it can be as simple as, in Mississippi, and David, you could probably speak volumes to this as opposed to me, but thinking about the resources that exist, knowledge resources that exist that are bilingual in Mississippi is almost non-existent. There, pretty much any sort of resource that we want to have talking about Mississippi state law, or, we do a lot of work with justice court and eviction rights that tenants have in Mississippi. There are no resources that exist in Spanish for Spanish speakers. The state just does not produce that. So, and similarly, when we're talking about payday lending, alternative programs, or watching out for predatory lending, we rely heavily on federal resources like the CFPB and the resources that they put out that are bilingual, just because the state itself, Mississippi, just does not have that option for folks. And so I think, on a real, sort of foundational level, making sure that people actually have access to the information in a language that makes sense to them. And then I think beyond that, there are, we've seen with Green Path and with some of the CFPB programs that exist to give financial institutions the ability to make small dollar, low interest rate loans to folks as an alternative to payday lending. Those resources have been instrumental in steering people away from payday loans. I think similarly, if those types of programs or resources existed in the homeowner context, in the, I don't want to say anti lease to own context, but in the alternative financing, home financing context, I think that would go a long way. And then again, on the side of the institutions themselves, making it clear that, like, to go back to the Social Security number versus ITIN scenario, making it clear to banks that they don't need Social Security numbers in order to provide mortgages and loans to community members, that ITINs can work, and really encouraging folks to in the institutions and in the banks and the credit unions to make these loans and to make the to provide mortgage opportunities to people who do not fit in with the traditional sense of a home buyer. I think both of those would be major steps for folks.
Yeah, I think those are really great remarks by Max. And I would just add that, we have more information now than we ever had on how people pay for their housing. It's important for policymakers to be thoughtful and inclusive when they're thinking about policies that support homeowners, that mortgages and rents are not the only ways that people pay for their dwelling. There's a lot of different arrangements. And now we know how many people have used these, 36 million Americans. And the overrepresentation we see for Hispanic households, that's not new. The census has some data back from 2009, even then showed that Hispanic homeowners were more likely to use land contracts than other groups by race or ethnicity. So this is not a new challenge, but we do have more evidence today, and we're already seeing, quite a bit of movement in addressing the problems associated with these arrangements, a lot of what we've heard here today. And also, again, helping to improve small mortgage access, which is certainly part of the solution. People will continue to use these arrangements, and so yes, more information and better protections will always help here. But also giving people safe, transparent, affordable options will go a long way.
Awesome. Thank you so much for that. And with that, we are about to close. So I will give each one of you briefly just a little small ending remark. And we'll start with John, go from Max to Tara.
Okay. Again, thanks again to you, David, and the CHCI for having me and for spotlighting this issue. I think what strikes me most is that this, although the issues are complex, there are solutions that are out there, and the lack of momentum around this, really, I think is a function of the sort of lack of awareness. And I think, by helping to spotlight it, it helps to helps us collectively to prioritize and to get some real momentum around the solution. So we're deeply appreciative of that. We look forward to maintaining a dialogue and hopefully being a part of that, advancing those goals together. So thanks again to the panelists. I always learn a lot during these conversations. So thank you.
And Max.
Yeah, absolutely. I'll also just reiterate my thanks and appreciation for getting to join you all. I think pretty much the work that you're doing, David, and that CHCI does on a daily basis or yearly basis really is the sort of, as far as finding information and then helping to craft policy based on that information, in so many ways is the only protections that folks in states like Mississippi, Alabama, in the Deep South, or in some of the other parts of the country that don't have the kind of protections built into the law for Latinos or for Hispanics or for immigrants in the individual states. So the work that you all are doing has a major impact in these states that otherwise there is nothing that exists. And the last thing I'll just say is that we just went through several rounds of severe storms here, tornadoes, in Mississippi and Rolling Fork in particular. We've yet to identify folks who have been in these rent-to-own schemes, but I'm sure that we're going to uncover some folks. And the question that we're going to have at the end of all that is, what kind of benefits are FEMA and MEMA? MEMA is like the Mississippi version of FEMA. What kind of benefits are they going to be able to provide to these should be or would be homeowners, when in reality, probably a lot of the benefits are going to be crafted to give to the landlords as the homeowners in these instances. Thank you.
And Tara.
I'll just echo my co-panelists here. Thank you so much, David and CHCI, for having this conversation. And I hope that this is just the start of these discussions. And, this is terrific. And, alternative financing has been, something that's been around for a long time, but not a lot of policy and discussion has been attached to this. So I'm glad that we're doing this today, and, just recognizing that Hispanic households are poised to become, the largest share of net new homeowners, per some evidence that Urban recently released, in the coming decades. And for a very underserved part of the community, that's terrific. And we should be really thoughtful about the ways in which people are paying for their housing. Seeing this overrepresentation in alternative financing This is a space where we should kind of focus some of our efforts and dig more into what those arrangements are. Are they working for Hispanic households? If not, how do we improve them? And if they are, how do we lift up those practices? And ultimately, the goal again is mortgages, gold standard in home financing. And so really thinking critically, especially at a federal level, about how to drive down those costs to make it easier to originate those. So thank you again.
Awesome. And thank you, Tara, Max, and John, for joining me in the audience. The audience, thank you for tuning in and for being engaged. And with that, this discussion has concluded and the panel is adjourned. Thank you so much.